Andy, thanks very much for joining us tonight. Is your microphone working over
There
there?
you go. That's it?
Can you hear? Can you hear him out there?
Check.
No, he's
No.
not on. Maybe it's in.
You hear me? Hello? There it is.
A little bit.
Better?
We turned it up.
Better?
Still that?
It's on but low.
Okay.
The sound man can fit. Whoa.
Wrong one. The other left one.
Check. Check.
Well, we can just we can pass the mic back and forth for
Okay.
figure out if there's a solution to the technical difficulty. So Andy, I imagine a lot of folks here saw the event on Facebook. Kind of the brief nutshell version of how you got here tonight and became CEO of ServisFirstBank was that you raised $14 million from local investors to create ServisFirstBank. But all that started because you had a relationship that went back a few years, and the founder of big ServisFirstBank reached out to you, and I can't remember the exact date, but could you tell us the story of kind of how you came into this position? You spent a career in banking, you never raised money, anything like that.
Yeah.
How did you go from being in banking to starting a bank and raising $14 million to do it here in Huntsville? And what did you kind of tag onto that? What did you wrestle with, or what did you think about as you were thinking about moving out of an already successful career at an established bank?
I think I was in a good situation. Where I was with another local bank. I had started my career there. I'd been there for nearly 15 years, for the most part, was happy. I was positioned in a path which, within about 5 years, I was supposed to take over the CEO role over there, which I really thought was my dream job. If you'd asked me 5 years before that, and this is 2005, if you'd asked me 5 years before that, what I wanted to do, it would have been to be the CEO of that bank, in Huntsville. And I would have thought I would have arrived at that point. That would have been the pinnacle. And so that plan was set. And I was again, I was happy, but I was also probably caught at the right moment. I call it maybe a little bit of a weak moment. But Tom Broughton, who was our original founder, Tom and I worked together when I first started my career in 1992 with, and I guess I can say which bank it was First Commercial in Synovus. Good.
Keep going.
And so
I don't exist.
So that was 1992.
Ignore the man.
And so, but I was always impressed. I was working in Birmingham right out of school, and when I joined that bank was about 7 years old, and so and it was still a relatively young bank, and at that point we had not even sold to Synovus at the time. But you okay? Good.
Yeah.
Okay.
Give him
And so, but I was working with a lot of people who had been part of that bank when it first started. Some of those folks, and everybody was pretty young. At the time, I think I was 21, 22 at the time, and some of the folks who had been part of that bank were probably in their late 20s, early 30s, and they were with the bank since day one. So they were part of that startup. And so to hear them talk about being part of the startup just interests me. It was always kind of exciting, but I kind of went, well, I kind of missed that. I'm 7 years in. I'm still a young bank, but I kind of missed that, that window. So I kind of went on about my career, and I moved up back home to Huntsville, which is my home. And so I was having a great career. Kind of moved up the ranks through the local bank, and again was positioned. Had been there for about 14, 15 years, and Tom had left Synovus because, to be candid, it wasn't the same bank that he had when he had founded it, And so,
It's a common story
yeah,
of
yeah.
startups that get sold.
yeah, I had a conversation with Bob Thurber today. We talked a little bit about Intergraph, and he said, I asked him what was more fun, being part of Intergraph or dabbling all the different companies that he's involved in now. And he said, he goes, it depends on which Intergraph you're talking about. And so he said the original one was great. You know, in the end, it wasn't what it once was. So, and I would say the same thing about, I think that was the same thing for Tom. And so he went out and was actually partnered with the Brock family, which were actually the founders of Central Bank, which later became Compass Bank. And so they had helped found that bank. And so you had two key guys who had been involved in startups before. So they raised some capital down in Birmingham and had been open only been open for just a few months. And this would have been in 2005. By August of 2005, I got a phone call from Tom. And Tom, I guess, had been kind of observing my career from afar, and said, hey, we just got things going. It's going better than expected. We really want to start a bank in Huntsville. He said, are you going to be in Birmingham anytime soon? And so I said, well, actually, I'm coming through in a couple of weeks. And he goes, well, let's get together and have breakfast. So it was one Saturday I came through, met him for breakfast. He showed up in shorts and flip-flops, and I think I was in shorts and a hat. And,
Bankers in shorts and flip-flops.
Yeah, it was on a Saturday. We met. Yeah, yeah, that's right. And then, so we met for breakfast, and that was like August of 2005. And he said, hey, why don't you come over to the office? Because it's no frills. It's kind of C-grade space. It doesn't really even look like a bank. And because they just got started. And he said, so we went there and we talked a little bit. And he said, hey, we've been throwing around the idea of doing something up in Huntsville, and just kind of think about it. And I said, okay, well, I'll think about it, but I'm in a pretty good spot. And so that was August. So I really didn't think much more about it. I kind of hadn't heard from him in a few months. And then I got a phone call in January of 2006. And it was Tom. I mean, it was like January 7th. I think he just wanted to get through Christmas. And then called me and he said, hey, we're ready to do that bank in Huntsville. Are you on board? Are you in? And I went, I'm just coming back from New Year's. I hadn't really thought about it. He said, we're ready to do it. He said, I'd like to get together. So I think that was intentional. I think he didn't want me to really think about it and lose a lot of sleep over it. So we ended up meeting, and I'm not sure how much further you want me to go, but
as far as you want.
okay. So anyway, so we ended up meeting, and we got together. I think it was at the Bevel Center, and so between then and that meeting, between that phone conversation and that meeting, I started talking to a few folks. I started thinking about, well, who would I want part of our team? And so I looked at the people that we had within our own organization, and then also looked outside and said, okay, who out there in the competitive world, who are we competing against that really kind of gives us the most fits? Who do we run up against a lot? And so I started kind of looking at that and said, okay, if we took kind of the best people from our organization and then your best competitors, then you kind of mesh those together, then I think we could do some great things, and also be open to ideas from each organization. And so that's what I did. I started making a few phone calls, and at the time I had already been had a couple other banks reach out to me about starting something here, and so there really were about 3 opportunities, and it turned out that one of the other guys, David Mathis, by the way, who's now moved on to be a part of a government contracting firm, but he said, I've actually been approached by those banks too. So there were a lot of feelers out there, and so we got together and we met with Tom, and Tom said, hey, I'd like y'all kind of put a team together, and part of that is we got to get regulatory approval, and to get regulatory approval to open up in Huntsville, to open the bank in Huntsville, we got to raise capital. And then I told Tom, I said, look.
And did he tell you at that point how much capital you needed to raise?
Roughly. We kind of knew it was going to end up being north of $11 million. And so, or $11 million or more, depending on the growth of the bank.
Was that nerve-wracking, the idea of going out and raising that kind of capital, having not done it before?
Yeah, I told him, I said, Tom, I think I can run a bank. I said, I know commercial banking. I know how to work with companies. I said, I know nothing about raising capital. And his comment back to me was, it'll be the easiest sell you ever made. and so he was just convinced that he, of course, he had done this before, so he was convinced that people would get on board, and so, and part of our model was, it wasn't just that we would raise $1 capital. We actually had a stipulation that if you wanted to invest in the bank, you had to also put your business with the bank, including, we used a 7-to-1 ratio of deposits to equity.
So for the audience, like if someone invested $100,000, they had to put $700,000 in a bank account.
That's right. That's right. And some of this was done in the form of groups. So you might have had an individual, their business. Maybe they also brought a friend in, and we set up LLCs to allow them to kind of maximize those deposits. But it really was it was a little bit of a different approach, because a lot of organizations, whether it be banks or they're concerned about raising that capital, but then don't really think about what's next. In our industry, we make our money off of loans. We can't loan $1 until we have deposits. Well, in this case, we can't open up an account and accept a deposit until we have regulatory approval to do so. And to get regulatory approval to do so, we got to raise the capital. And so, that's pretty much how we did it. So what we did is we said, okay, we're going to raise the capital and the deposits at the same time. And it was tough. I mean, it was tough really, what was tough about it was telling people no.
So that's what I was about that. So you did have to turn some people away that didn't want to put the deposits, but wanted to invest in the business.
Yeah, and we had situations where, I would get a phone call, or one of the other guys would get a phone call, and they would say, hey, we want to buy stock in your bank. And I said, well, here's here's our here's kind of the way we're doing is you also got to commit your business to us. And in some cases, even folks who had plenty of money to do so, they just said, hey, for whatever reason, I'm loyal to this particular bank or this particular banker, and I really can't do that. And I say, hey, that's fine. That's perfect. We understand, but we can't really break from our model.
So let's dig into this decision making as far as deciding to make the leap a little more. Because I think a lot of the folks I talk to that come to co-working night, like, maybe they're working for a government contractor, or they're kind of doing something every day they're not real fulfilled with, but they're making pretty good money. Maybe they got a spouse and kids at home or whatever. And you were in a similar situation in that, on the surface everything looked good. You're like the heir apparent to the bank and all this, right? But you told me when we had lunch the other day that you kind of found yourself. I think you said making mountains out of molehills. Like you were, I kind of compare it to it's almost like sort of getting toward the end of a bad relationship where you just kind of start making a big deal out of stuff that's not really a big deal, right?
Mm-hmm.
It's like what you described. So why don't you tell the audience a little about the story you told me the other day about you met with a mutual friend of ours, Ray White, to kind of help you make this decision.
Yeah.
And the advice he gave you as far as, do I stay or do I go?
Yeah, and go back with your comment about making the mountains in a molehill. Again, I wasn't in a bad situation. Most people would say I was in a really good situation. But my wife's here, Sarah Lawrence. So she was probably hearing me come home from time to time, a little agitated with little things. But yeah, there's no doubt that.
You're just not really fulfilled with what you're doing.
I think in the end, for me personally, I think it was the same for the other guys. Is that I think they were getting a little bit bored. I think we were getting a little bit bored. I think we felt like we really kind of lost, a lot of control of what we could and couldn't do over at the other place. And again, it doesn't mean that it was a bad organization. It was just different. It had grown as big, and so we really weren't able to make a real impact on the decisions we were making locally. Really weren't making a big impact on the overall company. And so little things that may have not bothered me before tended to bother me a little bit more. And so, we talked a little bit about the satisfaction curve. I think John, who used to work with us, Drew probably hears this. We talk about the satisfaction curve. You get peaks and valleys, and that goes with that. A lot of times you're really, really high on what you're doing, and every once in a while you get in that little rut. You're like, everything kind of bothers you. Everything kind of gets to you. The same we talk about that goes for clients, or prospects that we're calling on, or even prospective employees. You got to be calling on them all the time, because if you call on them very sporadically, you might always catch them on the peak, you know,
The
when they're
consistency
happiest.
is the key because it's
Yeah,
variable, right?
Yeah, and you know, but if you're calling on them enough, whether it be a prospect or a prospective employee, you're eventually going to catch them in one of those little valleys, you know, when they're a little bit down. And so, I think maybe Tom caught me a little bit in one of those valleys, and so so that really kind of peaked. You know, at that point, I was kind of like, yeah, let's talk. So.
So tell us about Ray's Ray's advice.
Ray's a good friend of mine, and so you know, so obviously my wife was great through the whole process. She you know, she said, hey, I just want you happy. I'll support you in anything you do, and so so she was awesome about that. You know, but you know, I still feel like I needed to also talk to some, you know, some folks I could really confide in. I mean, you really gotta have those people you can really confide in. So I went to talk to Ray. I said, you know, I was kind of struggling with this, and it was a little bit of a tricky situation too, because Ray's dad, Sydney at the time, was sitting on the board at the place I was employed by, and so it was a little bit tricky. But I had a lot of trust in Ray, and so we talked. I presented the opportunity to him, and he said he really put it in perspective, and I've actually used that with other folks who've come to me. But he said, hey, well, what's the real downside? Because what is the actual downside? And I said, somebody think about this. I said, I guess the downside would be that you know, we can't raise the capital, we can't get the doors open, we've resigned our positions, you know, and we're sitting out there and we can't get regulatory approval because we haven't raised the capital. He said, okay, but what would happen if that happened? And I said, well, I suppose I'd just go to work at another bank and, you know, probably you know, doing okay. He says, so the downside is you would just go to work for another bank probably in Huntsville, probably doing okay. And I said, yeah. He said, it doesn't sound like a lot of downside risk. And so he put it in that perspective, and it's like he said, but the upside is so great. He said,
I think that's such a crucial insight, though, because, you know, as long as the downside is undefined, as long as it's this kind of amorphous thing, it seems really big and scary, you know? And then when you get it defined, you're like...
And he really helped me do that. I mean, he really did. It was a great exercise for me. And so, yeah, and so I kind of looked at that and kind of went, well, that doesn't sound like a lot of downside. I mean, it wouldn't be ideal, but it's, and also at the time I was 37 years old, 36, 37 years old. And the other thing he brought up was, he said, look, he said, you're old enough to kind of know what you're doing. He said, but you're young enough to, if you can't get it open, then you can start over. And that was true.
So you had a tremendous amount of success fundraising as a rookie fundraiser out there. I know you had a great team and you
great
had
board
pedigree.
too. Great board.
You had great history around the core founders there, but all of a sudden you had to get out and do the work. What was that like out fundraising, and like what kind of advice would you give to you know, I think we have a lot of folks that come to these events that if they're not fundraising, they're thinking one day they're going to need to do a capital fundraise to do something.
Yeah.
What kind of advice would you?
Well, you better have a good story, because you're going to tell that story over and over and over again. And we had a lot of help. You know, I do want to recognize Danny Wyndham. Danny is one of our board members and was one of our original board members. And it helps having folks like that who want to help you from the get-go. You know, who have an entrepreneurial spirit. You know, we had David Slyman, who's, you know, he and his brother basically created Providence. You know, when we went to see him initially, he said, what do you need? You know, do you need space? And we're like, well, shoot, yeah, we need some space. So he set us up in some flex space up over in Providence, and we were sharing space with let's see, It's Just Lunch dating service. There was a residential appraiser in one office. There were about 4 of us in our offices. We had a government contractor who I think might be a little bit crazy, was in another office. So it was basically we were sharing all that flex space, sharing a boardroom and all that. But in the end, we just really had to just hit the streets. And part of the issue was, you know, this was March when we basically resigned our positions. We didn't actually get open until August. So there was about 5 months where we were kind of hanging out there. And during that 5 months, we were essentially, you know, going out, starting with a breakfast meeting, to meeting with people in the morning, having a lunch meeting, meeting with folks in the afternoon, and then even having dinner meetings. And my wife remembers this. I mean, there was probably about 3 months where it was pretty much, 6:30 to 8 o'clock, and really you just couldn't, you had to just get in front of as many people as possible. And that included not just potential investors who would also be your customers, but we also had just customers that just wanted to be our customers. They may not have been positioned to, or had really even any interest in the equity position, but we still had relationships with those folks. Well, at the same time, during that 5 months, all of our banks that we left were kind of circling the wagons, and so we had to make sure we were getting in front of those folks on a regular basis to make sure, are you still in when we get the doors open? And so we had to get those commitments too. So yeah, we had a lot of early mornings and late nights.
So obviously the work ethic's important there, and you've been on both sides, right? You've been someone out raising investment, and now you've made a few angel investments. We were excited you invested in Tango. So that's how we got to know each other. What do you look for, now that you're an investor and you've been on the other side of the table, what are you looking for from that person pitching you, that founding team, that company? What are you looking for in an investment deal?
Well, we talked about this, and I'm always looking for what skin in the game do they have. If you're asking me to, and this is both from an equity play to me with my banker hat on and lending money, is, hey, we want to know that those founders have either cash equity in, or personal assets in, or family money in, whatever, that they have their own skin in the game. It's very hard for me personally to put money into from an investment standpoint, or loan money from a banking standpoint, with a company where the owners aren't willing to do that themselves. We've had, I told you a little about some folks that come to see me where they were really not in a position where we could lend them money. This is with my banker hat on, and when I asked about, hey, it looks like we're probably going to need to look at personal assets, and the response is, oh, my spouse won't let me do that. And so, I kind of step back and go, well, gosh, if the person that's closest to you, doesn't show that kind of confidence, and I think you made a comment that, and this person probably is the most biased towards you being successful. If they're not willing to put that at risk, then it's hard for me to do the same, or for the bank.
And of course, people are going to say, well, my spouse is risk averse, but the bank's really risk averse too, right?
Yeah.
It's not a big, talking about 4 or 5% interest.
Yeah.
You lose on one, and
Yeah.
that's a lot of successful profit.
Well, we talked about this, that there's different points in the business life cycle where different funding sources come into play. You obviously have your angel funding.
Yeah, could you expand a little bit on that? Because I think that's a really good insight for the community.
And so you have you have a point where you're looking at kind of friends and family. You got points where you have angel investors. You have the VC folks that can come in at some point as well, and then of course there's banks where you can borrow money, for some of your needs. But if you look at that kind of spectrum, you're going to look at risk return. So obviously the owners, the founders, they obviously have a lot of risk, but they have a tremendous upside potential. You got your VC folks that come in, and they might be involved in mezzanine financing. Maybe they're looking at 12 to 15% return, but they're willing to take on a little more risk for that type of return than maybe a bank. When I tell folks, when I have kind of put on my banker hat is, if we make a company a loan at 5%, well, let's take the owner for example. So your money goes in. Your downside risk is you lose that money you put in. Your upside risk could be exponential. It could be 20 times whatever. It could be more than that. From a banking perspective, our downside risk is the same. We lose the money that we loan the company. Our upside risk is 5%. So we have the same amount of losing our principal, just like the equity for an owner, but the upside is limited. And so that's why when we look at it from a banking perspective, we're going to look at it, we're going to be a little more risk adverse.
Yeah, I think that's really good to know for early stage folks. They're thinking, hey, can I borrow money from a bank or something? I mean, that's critical to know.
Yeah, and there are cases where really you can, but I think in that case, we're going to look to other assets. We're going to look to personal assets. Is there somebody willing to step up from a personal guarantee standpoint? It may be that you may not have it to do so, but you have a family or a friend or an interested party that's helping you that may be willing to step up as well. So we're going to look to kind of tie that up a little tighter, given the that stage of the business.
So I'll shift gears a little bit. You've going through fundraising. I mean, I've dealt with a lot of really successful, high net worth, if you will, individuals. And out of all of them, you're probably one of the most available, responsive folks. Where I ask you a question or need something, and you're like right back, right? And that tells me you must be very good at managing your time. We had Amanda Howard here a few months ago, and she kind of talked about. I think Brandon mentioned this later, like the daily tornado, right? Of just you could get caught in that, and you're just like spinning, and nothing's really getting done, and obviously you figured out a way around that, or you're at least not buried such that you can't be responsive. How do you think about time management? Or
I think I'm learning over time. I don't think I've completely figured it out, but I think part of it is a lot of, at least for me anyways, a lot of our success, or even my success in my personal career, this even before we even started the bank, I got to that spot because I worked real hard, and I was very hands-on and very, put in a lot of hours, all those things. I really kind of felt like, I could outwork other folks. That's fine to a point, but as you take on more and more responsibilities, and our organizations continue to grow, you really have to delegate. You really have to have confidence in the team around you, and try to delegate more. And I think I feel like Drew's here, John's here, but they may say differently. But I feel like that I don't micromanage quite the way I used to. I think if you probably look back 10 years ago, I probably tended to be on top of everything a little closer, and probably drove a lot of the people around me crazy because they're like, "Hey, I know what I'm doing. Let me do it." And so, and partly I had to do it just again to find the time. I needed more time to be able to do other things and focus on things that maybe only I could do, in the role that I was in, as opposed to being focused on things that other people could do.
right.
And at the same time, it allows them to grow. And so, and they're probably going to
So
make
then
a
you
few
got double
mistakes.
benefit. Like your time's
Absolutely.
freed up, and then
Absolutely.
they're more powerful, more productive.
Yeah,
than
yeah, and it's going to be a little bit, it's going to be a little bit sloppy at first. I mean, they're going to make a few mistakes, or they're going to do things a little differently than you would, and you try to coach through that. But you also kind of go, hey, it's, if you're going to give them that kind of leash, then then they need to be able to fail a little bit too. So. But yeah, it's been, it also frees up more time for me. And over time, you start going, okay, I feel better about their ability to make decisions. And wow, my life is a lot easier than it once was.
In our lunch Monday, and actually in your tips that we put on Facebook, you hit on something that I don't think I've heard hit on very much before, if at all. But I was like, wow, that really is an important thing. You talked about integrity, which is talked about a lot, but you also talked about openness.
Mm-hmm.
Kind of people not feeling like you're like keeping stuff back or whatever. I mean, integrity kind of goes without saying that you're going to get, if you don't have that, it's going to catch up to you eventually. But could you talk to us a little bit about the value you see in openness and what you mean by that in business dealings?
Yeah, and I said it in business and in your personal life. I mean, I like to surround myself with people I trust, and so, and that both in business and personally, and I said that's not just about whether somebody lying to you or not lying to you. That's a little more black and white. It's really, are they being upfront and honest with you about and giving full disclosure, whether that be an employee, a client, a friend. Are they really kind of disclosing all the relevant information? And if they're not, are they really being truthful with you? And so, if it's an employee, you feel like, hey, I think they're maybe holding back, all of the information, it makes it really hard for you to trust that they're making good decisions or that they're trying to get things past you without disclosing all the information. If it's a client, I think I mentioned this. We just don't like surprises. If the situation's bad, let us know, and then we'll all kind of know how to deal with it. If we feel like that maybe a company is not giving full disclosure about events that are happening in their business, it's eventually going to come out anyways. And what's even worse is if we thought that, hey, we had prior meetings and you really didn't disclose that, it really makes it hard to kind of take that relationship any further, because it's hard to gain that trust back. It may take time, or it may never happen. And it's maybe best to part ways.
I've always heard trust compared to like a ladder, right? Like you're climbing up slowly, rung by rung.
Yeah.
It takes a long time. It's hard work. But then you let go.
Yeah.
You let go for 1 second and
Yeah.
undo.
It really, and that, again, and I think it goes with, again, employees, clients, and then your personal life too. I mean, think about when you feel like somebody is not really been full and open with you. What that's done to your relationships, and so. But again, if you fully disclose that, we can work with that.
Yeah.
We can kind of move past it and figure out how to come up to it with a solution together.
So you mentioned they were in your rules and they were are your tips, and you mentioned this at lunch the other day. What you feel like the importance is of having people that are kind of 10 to 15 years ahead of you in age, or kind of in the success curve, or however you want to define that. Who were those people for you? Kind of your mentors, and what did you learn from them? I mean, you've been very clear throughout all these conversations, like, hey, this isn't about me. There's been so many people around me that have helped me.
Yeah, and really the reason I said that 10 or 15 years, and this doesn't just apply to business. This applies to your personal life. John and I talk. He's got 2 little girls. I've got 2 girls. I guess mine are probably about 8 to 10 years older than his. But you know what? I confided in people who were 10 or 15 years, who had kids, 8 to 10 years ahead of my girls, and I asked those dads about how to raise girls and their opinions. And so you just get that insight because they've seen more than you've seen. Just like the folks in business, and again, I know we got a lot of bright folks in here who are young, energetic, and have a lot of successes. But at the end of the day, the folks who are 10 to 15 years older than me, even 20 years, they have just seen more. They have seen more. They've seen the economic cycles. I remember early in my career, it was during the 90s, where you had the techs were booming. Real estate market was going great. I was still young in my career. I remember mentioning one time to my boss, I was trying to get a deal done, and I said something along the lines, and again, this is during a decent economy. I said something like, "Oh, I won't lose any sleep over this one." And he stopped me and he said, "But you should." And he said, you should always lose a little bit. He said, because it's not going to always be like this. And the reason why I didn't really know it wasn't going to be like that is because I hadn't seen all the economic times that he had seen. And so, and I say the same thing. It's easier for me to see today because I'm still talking and listening to people who are 10 to 20 years ahead of me. Whether that be asking them personal questions about personal life or about business. They've just seen more. And a lot of times they've seen more through spilled milk stories.
Oh, yeah.
They've had mistakes and they've had things not go their way, and so they're able to share those things with you. And I feel like I can do the same thing with folks who are 10, 15 years younger than me. And again, it's not that I know everything, I've just had more experiences.
It reminds me of there's a saying in investment circles, and I might be butchering this a little bit, but it's basically smart money is just dumb money that's been through a crash.
That's pretty good. Yeah. And again, we also have to need to make sure we have long memories because we're kind of hitting a boom time right now.
Yeah.
I was telling somebody the other day. I said, for our industry, if you can't make money in banking in the next 5 years, you just need to get out because we're poised to do really well. Our industry, the economy's good. The tax stuff helped a lot of our corporate clients. There's some deregulation happening, interest rates creeping up. All those things really are kind of a perfect storm for our industry. But it's not going to always be like this. So let's remember that let's remember 2008. Let's remember that real estate values aren't always going to be up here. And again, let's learn from those mistakes.
Can you tell us 1 to 3 books or other media, podcasts, YouTube videos, whatever, that you feel like greatly influenced you, your career, your life?
Sure. And I know a lot of the companies that were involved in this book actually had issues later after the book was written, but like Good to Great.
Yeah. It's funny. I've had so many people mention that one, and I have suggested that one to other people, and it has like sparked off an interest in business books.
Yeah, Jim Collins. It's
really good.
There are a couple of things, and we talk about this a lot even today around the bank about the bus.
Yep.
You gotta get the right people on the bus, and then get the right people in the right seats on the bus. And we talk about the seats in the bus a lot around our organization. That sometimes we got the right person, but are they in the right seat?
Yeah, totally. If you're asking the wide receiver to play left tackle, that's not going to go real well.
And sometimes we've made a mistake where we've taken somebody from a good seat because they wanted an opportunity. We wanted to kind of move them up the ranks, and we put them in a seat that it just didn't work. And in some cases we just have people on the bus that just need to get off the bus. And it's not that they're bad folks. It just means that maybe our organization is not for them. Our culture is not for them. It's not for everybody. Maybe they're not comfortable making decisions. Maybe they need to be in an organization where the decisions are a little more defined. The parameters are more defined, and they can be more successful by saying, okay, if you tell me this is how I can approve a loan or not approve a loan, I'm comfortable doing that. But I don't want to have to kind of step out there. And again, it's not that they're not good at what they do. It just means that they're probably better suited for another organization, so they need to get on a different bus. So I thought that was really, and I think the hedgehog concept too was pretty interesting in that book, because one thing that we've done from day one, we've really just stuck to what we do well, which is commercial, private banking, cash management. Since day one, everybody kept asking us, "Are you guys going to do wealth management? Are you guys going to do insurance?" And we said no. And I know a lot of people didn't believe us, particularly the people doing wealth management and insurance. But we told them from the beginning and said, hey, we want to do what we do really well and just keep doing it. We're going to leave that other stuff up to the people who are the experts, and then we're going to align ourselves with folks who we can refer that business out to, and that can take care of our clients that we trust that can take care of our clients. But we want to stick to what we do well and not stray from that.
So last question for me, then we'll have 5-10 minutes audience Q&A here. What advice would you give to, say, somebody right out of college that's got the entrepreneurial bug, an ambitious person? What would be your advice to somebody, early 20s or maybe even 25 or 30s, kind of at that point in their career? Just general life advice, career advice?
Are you saying starting a business or just going maybe
has that interest that they're not, maybe they have the itch, they're not maybe the idea of just punching a clock somewhere. Obviously there's people in the world who I've got people who work for me that I think if they could be doing the exact same thing 30 years from now, they would love that.
And there's nothing wrong with that.
And there's nothing at all wrong with that. The world needs people like that. But there's also people that are they're ambitious, they've got an itch. For that kind of person, which I imagine is probably most of the people in this room, what would be your advice to them if they're young, life's in front of them, world's in front of them?
Well, I think you got to surround yourself with great advisors. I really do. I think going back on that, people who are 10 to 15 years older than you, and I think the people who, like you are doing here today, here in this organization, is surround yourself with people who are also similar in age. You're going through the same type of things, and again, this doesn't just relate to business, this relates to your personal life too. I've been involved with a group for 18 years now. We're all roughly the same age. We're all professionals. We all have families and kids that are roughly the same age. You can just you can share similar stories and similar struggles and get advice. So I think the same thing with folks in business is surround yourself with people who are going through the similar things that you're going through. Similar struggles, and and align yourself with those folks. And then also, again, like we said, align yourself with folks who have more experience. And be open to what they're telling you, because they have seen more.
And that's great advice and a nice way to tie up the structured part of this interview, kind of tie back into some stuff we talked about earlier. So I'd like to open it up to you guys. Does anybody have a question for Andy? Matt, back there in the back.
So I wanted to ask you this the other day.
Yeah.
I'd like to know if you ever had a point in your career where it was just a bad day, things went wrong, you started questioning, should you be in this?
Wow.
What does that look like? Could you make any sense?
Which day of the week is that? No, there's, again, I have my weak moments. There are times where you kind of look and go, okay, we've been at this for 14, for 12 years now. It's how do we kind of keep it exciting? I think you just got to kind of find the why in what you do. Why are you doing it? I remember, again, this goes back to talking to people older than me, or just with more experience than me, is that you kind of got to figure out, okay, it's really no longer about the money. It's no longer about, kind of career advancement. It really starts to be, okay, can you have some type of influence, at least for me, can I have some type of influence on the people around me? And whether it be internally, other people that you might come in contact with, heck, I'm enjoying this today. I don't know if I'm helping anybody at all.
That's fantastic.
But I think it does become about, taking what you know and what you've learned, and can you somehow help others, with that knowledge. I think I'm in the position where there's really not another position for me to kind of move on. I really have no interest in taking Tom's position when he eventually steps away, and I want to live in Huntsville, I don't want to live in Birmingham. We did our IPO, and that was good for a lot of folks, and so it really kind of is, okay, why are you doing it now? And I think you got to find that why.
That hit on. And I'll mention this because I started to post it to Facebook after the last event. Mayor Battle was talking to him after the interview last time, and he dropped what I think was maybe one of the best lines of the night. I was talking to him about his schedule that night, and he was getting up to be on a radio show at like 5 a.m. the next morning, and I was like, man, what kind of hours are you working right now with the campaign and being mayor and all that? And he said, Trey, I love what I do, and if you know your why, if you love what you're doing, the hours don't matter. Yeah. And I was like, man, that sums it up well. So who else we got? Brandon?
Andy, thank you for coming, first of all, and general, this has been phenomenal. Yeah. I think what you really said echoes a lot with me on having those people 10 or 20 years into the future. And I've been fortunate to have those people, including Danny, who's been super helpful through my career. And I get this question a lot from other entrepreneurs, and I think I have the same one of like, how do you find those people? Like, how did you kind of grow close to Ray and have those other mentors in your life? How did you kind of come about them?
Yeah, it's funny. I don't think I really seeked them out. I think it just happened through other relationships. Danny and I go back, really go back to the other bank, but we met other people through, like when we formed our local board. It was formed with some people we already knew, and it was also included other people we didn't know. And some of those were because other people suggested, this is somebody I think could be of benefit to you and be able to help you. And so, it was just talking to those people. And if you hear that same name enough times, you start going, okay, this is like the fourth time somebody's mentioned this person to me. Sounds like I need to go to lunch with this person. And so, and then you can kind of sit down with them. And I'll say this, and again, we keep talking about older people and people your age. Hey, I'm going to learn from folks younger than me too. You folks who are so entrepreneurial. I mean, you're gonna have ideas and thoughts and ways of doing things that I hadn't thought of because I hadn't seen them. And it is a new day. Technology's new. A lot of the things that we talk about just when the bank's technology is based off of what we're hearing from people who are using other technologies. Danny's been great about, he's really kind of our technology expert on our board, but it's also because he's around people who at Digium who are younger and innovative and coming up with all these ideas that maybe folks like us just aren't going to be able to see.
That's good.
So,
What else we got? Dick?
Your focused business model, Andy, sounds a lot like Jim Collins' later book, Great by Choice.
Yeah, and I have not read it, so
It's wonderful.
I need to follow up on because I did like the other one.
It's really good.
Well, and Go ahead. There's one thing I was going to touch on. One thing I didn't really touch on is kind of a little bit with our money. I had when we were raising our capital, and we were telling this gentleman's now deceased, but it was his name was Earl Van Dyke, and he actually was this older gentleman who ran Alabama Concrete. And we went to see him, and we did our pitch. So, we were like, okay, we told this story hundreds and hundreds of times about what we're going to be and why we're going to be different, and all this. And so when we brought it up to him about, but part of the deal is, you got to commit to banking with us. It's kind of the old thing of, if you're a tailor, you don't go buy your suits from Nordstrom or Belk or anything. You make your own suits. And so when we were telling the story, he said, it's like a co-op. Like a farmer's co-op or one of those kind of co-ops where everybody's putting in, but you're also using the service. And I went, I never really thought about it that way, but it was a great way of looking at it. Is that, hey, it doesn't make sense for you to put your money in and then do your banking over regions or somewhere else. If everybody does what they say they're going to do, then your value, your equity value, is going to be so much greater in the long run. If you're doing your business with us. If you want to piss off Tom Broughton, you go to lunch with him and pull out a credit card that doesn't have our name on it. He'll come unglued. And so. Because it just makes no sense for you not to use your own service.
Well, and we kind of glossed over that, but that model, that fundraising model, somebody here tonight might be able to find a model like that with their customers and clients. It's brilliant, you not only, you raise capital from them, but you had kind of a guaranteed run rate of business, which kind of put a floor.
I'm still amazed that there have been other banks that have started since we did, and they didn't duplicate that. And I think part of it is that fear of not being able to feel like they could raise the money and all that. But it's such a slower process to do that. It is a more disciplined model. You got to be able to tell some very influential people no, and that's hard to do. We can't stray away from our model. But in the long run, it just pays so much bigger dividends.
Another question or two? I saw a few more hands earlier. Yes, ma'am.
Curious, banking is a very well-established industry, and it's very crowded. So what made you think that going into a very crowded industry that you were going to succeed?
Well, part of it was, it's a great question. We now are in 10 different markets, and so it's fun to talk to kind of my peers within those markets. And so I think one day I was telling Bradford Vieira, who's our CEO in Nashville, which is a great economy, just booming right now. And I think I was saying something along the lines of, hey, we got 30-something banks in Huntsville. It's so competitive for deposits and loans like that. He goes, man, I don't even want to hear about it because we got 60 up here in the Nashville metro area. And so, it is a real competitive environment. I think one thing that we didn't really touch on is, and I don't know that I completely bought in when we started this, because I think, I came from an organization where we were very much in a branch expansion mode. It was still the old way of you gain exposure by having a branch on every corner, and that's kind of how you build your brand. Is you got this big fancy building here or there, and you got to be in this particular geographic area, this particular neighborhood, what have you. And one of the things that I give Tom so much credit for is he saw the fact that the branches. He would always say the branches are going the way of the phone booth. He said, the industry is going to look completely
And he was saying this, so he must have been saying this 10, 12 years ago,
exactly.
Right?
And matter of fact, we were the first in our market to offer remote deposit.
Oh, wow.
And we did it because we kind of like, okay, well, it's an excuse for us not building a $3 million branch and having to put up employees and pay benefits and everything else. It's kind of like, Tom's just kind of being cheap. But I think it was just basically where he saw that, hey, no, this is the way the industry's going. Not just our industry, but other industries. And so, it took me a while to kind of really buy into that, but it's true. We're third in market share in North Alabama, and we've done it with 2 branches. And I always say that we probably got half to 1 branch too many. But kind of connecting your question is one of the things we've been able to do is, in banking, when it comes to loans and deposits, those are not going to vary much from bank to bank. So what we offer in a loan rate is not going to vary much from what Regions or another bank's going to offer a loan rate. Same on deposits. So that's our cost. So that you got your revenue, you got your cost of goods being your interest costs. Those are not going to vary. That little margin is not going to vary much from bank to bank. Where a bank really can make money or those lines below that margin, which is how do you manage your overhead and how efficient are you? We call it efficiency ratio with your operating costs. And do you manage your problem assets properly? Do you limit what you charge off? What bad decisions you make? And really, that's where you make your money in banking. And so, if you can eliminate that branch system and try to implement as much technology as possible, and then of course make good decisions when it comes to lending, that's where that differentiator is. And going into it, we knew we were going to be an efficient bank. And we also knew that a lot of our competition, once you have those branches in place, it's really hard to unwind those. I mean, you've seen, what do you do with a bank branch? I think there was, one of them was a Kenny Rogers roaster at one time, and then you got a couple of dry cleaners, but it's like, it's just, what do you do with those buildings? And it's just really hard to unload those. And so, and the regulators these days are asking a lot of questions about that because they see the same thing happen with our industry that's happening with other industries, is that people just aren't going into bank branches. They're not going into, they're not buying a lot of clothes at retail outlets anymore. They're buying stuff online. They're doing their banking online. They're not really walking to the branch. And so I think that we just saw that ahead. That was a great opportunity for us to be able to be efficient, be able to bring a greater value for our shareholders, and that's remained true. So, and as a matter of fact, I always say this: that when I see a bank build a branch today, I kind of think to myself, you just made us more competitive. So.
Well, Andy, thanks very much for coming out tonight. I think we'll wrap things up now. We're bumping up against the 7 o'clock workshop. So, but I'll tell you, this has been fantastic. We talked a little lightly about this at lunch the other day, but I don't think we've quite had enough time to touch on everything we'd like to. We'll have to have you back on the podcast, which all you guys should check out, by the way, the Urban Engine podcast, where we have these same kind of conversations. So we'd love to have you back for that and hit on some of the stuff we didn't have time for. And thanks again for coming out and talking to all of us.
Thanks for having me.
No, I don't think so. It's hard to hear back here.
So is it cutting in and out?
No, yours was great. It's fine. No, the second one was great.
I wasn't. Okay.
We already did, dude.